Well, good morning, Jaginder Rana here. So the topic for our discussion today is mis-selling of insurance by banks. Mis-selling of insurance by banks. Finance Ministry's Department of Financial Services has directed lenders to stop offering incentives on insurance sale to curb mis-selling. It has restricted financial institutions to sell insurance policy only based on customers' need and not link them to sales targets. Mis-selling occurs when incentives overshadow customer needs. Bank employees are set target for selling financial products, including insurance. But their incentives or commissions depends upon it. This creates unwarranted pressure, pushing bank employees to sell products that do not meet the customer's need. So insurance is often sold by a trusted bank. Insurance is often sold by a trusted bank employee, but that trust tends to be misused. Rather than being sold as a risk cover, insurance is presented as a saving cum investment product, but it often does not deliver the promised returns. Limited financial literacy worsens the situation. People realize years later that they have paid premiums for a product that offered them very low returns. So to meet targets, bank staffs post unsuitable policies. Customers who visit bank branches are often pressured into purchasing insurance instead of fixed deposits. High returns are promised on these insurance products. Elderly customers are sold long-term life insurance plans that they do not require. So mis-selling also occurs when customers are told insurance is mandatory for the approval of their home loan, personal loan, business loan, or overdraft facilities. When customers are in a hurry to get funds, they are vulnerable and hence agree to buy an insurance policy. So customers can avoid falling prey by spotting red flags. They should become cautious if insurance is presented as mandatory for getting a loan. The pressure to decide immediately terms of the products are not explained clearly or documents are not shared in advance for review. So customers should also beware if they do not understand the details of the product. If you do not fully understand how the product works and the person selling it does not give you written information or avoids answering your questions clearly, that's a red flag. Also be warned whenever a pitch feels too good to be true. So before buying insurance, customers should assess their needs. Ask yourself why you are buying this product, for protection or return. Try to understand whether the product is suitable for your life stage and whether it can help you meet an important financial goals, such as children's education or retirement. Determine the type of policy that will best safeguard the assets that you wish to insure. So ask the bank whether insurance is mandatory for getting loan approval. Ask for a response in writing. So the customer may be required to pay multiple premiums on a product, but the bank staff may convey the impression that it is single premium product. Customers must fully understand the financial commitment and the duration of payment required. They should also ask if the policy can be cancelled or transferred if the loan is prepaid, and whether refund of premium for the residual term is possible. Verify if the product is a pure insurance cover or an insurance cum saving product. Inquire about the returns you can expect, whether they are guaranteed, the death and other benefits. Ask about the risk involved and consider whether you can afford them. So understand the lock-in period and how easy it is to get your money back if needed. Request brochures and read them thoroughly. Get a written communication in the mail on the benefits that are being promised. So, comparing products, reviewing terms in detail, and consulting a financial advisor is necessary. Make use of the free look period to cancel the policy. The insured is allowed a period of at least 15 days. 30 days in the case of electronic policy and those sold through distance mode. So from the date of receipt of the policy to review its terms and conditions and to return if it is not possible. If the free look period has passed, start by contacting the customer support service of both the bank and the insurer. If the policy was sold through a bank branch, approach the branch head or the designated grievance officer. Explain the issue and request a resolution. If the issue remains unresolved, escalate the matter. You can file a complaint with the Insurance Ombudsman on the Insurance Regulatory and Development Authority of India, Bima Bharosa portal, or file a case in a consumer court. Because the rampant mis-selling of unnecessary insurance plans to loan and deposit customers by lenders has already evoked concerns among the two sector regulators. Now the Finance Ministry has asked banks and non-banks to stop offering incentives on insurance sales to eliminate the malpractices. As lenders link employees' performance and incentivize to selling insurance products, the Ministry Department of Financial Services has issued a specific instructions asking lenders to immediately review their marketing practices. According to two people aware of the development, they said the DFS has told financial institutions that insurance plan should only be sold as per the customer's requirements, and sales targets should not be linked to incentives. So the ministry directed banks that their core banking services should not be forcibly linked to the insurance products, advising them to promote financial literacy among customers and employees for the healthy development of India's insurance market. Well, the first person quoted earlier said, queries emailed to the Finance Ministry and the Financial Services Secretary remains unanswered till press time. The Insurance Regulatory and Development Authority of India and the Reserve Bank of India have flagged concerns about such mis-selling by banks and non-banking financial services companies. Lenders bundle insurance plans with products like housing loan and local facilities. So at times, customers are even unaware of the term. Mis-selling can be deliberate by an insurer or its agent or any intermediary, or a result of poor training of the salesperson. So as regards deliberate mis-selling, there should be deterrents or disincentives in place, such as regulatory action by way of fines or penalties, or delicensing in egregious cases. So incentives structures that promote mis-selling, such as hard pressure-based selling, compulsive selling, etc., must be removed or discouraged. Non-deliberate mis-selling can be addressed to a large extent by proposal sales training and channel development. A large chunk of about 52,500 complaints received by the Insurance Ombudsman across the country in financial year 24 pertain to mis-selling and misrepresenting policy terms and conditions and issuing a policy not conforming to the proposal under section 13(1)(d) and section 13(1)(g) of the Insurance Ombudsman rule. So more than 70% of the complaints were filed against life insurers under the two sections. After life insurance health cover related complaints follow this list of grievances. Thank you.